Alright, so in the first part of the video, we said that the S&P 500 has recently made a new all-time high. It's made about 31 all-time highs this year. And a lot of people would say that, there's nothing to buy, everything's overpriced. But that's not true because, again, it's only a handful of stocks in two sectors that's really driving this bull market this year. So as I showed you in the last video, you can see that it's primarily the technology stocks and the communication services stocks that is contributing to the majority of gains for the index. And not just all technology stocks, specifically AI-related hardware stocks. There are many other technology stocks that have been left out of this rally. Companies like Accenture, which is in IT consulting, software companies like Salesforce or Viva Systems, and also you've got big contributions from Google and Meta, right? Now again, you can choose to chase these stocks that have been leading the rally. You can choose to chase NVDA, you can choose to chase buy Microsoft and Apple, but I wouldn't do it at these levels because again, I don't like to buy a stock. Even though they're great companies, they will go up in the long run, but I don't like to chase them. I don't like to buy them when they are short-term overextended and short-term overvalued because they will have better prices to add to in the next pullback or correction. And right now, NVIDIA may be going through a bit of a pullback. It's now down 10% from the recent highs, and it may retrace a bit more to give investors who didn't get a chance to get in, give them a chance to start adding. But in the meantime, while they are still not cheap enough, there are some other companies that could be of great value. There could be companies that are attractive. Now, let me just say that, don't buy a stock just because it is cheap, because cheap crap is still crap. So I know, for example, some people, they look at certain stocks like PayPal, they say, well, PayPal's, down so much. Let's look at PayPal, for example. All right, you can see that PayPal has been totally left out of this rally, and PayPal is down quite a bit from the highs, and it's been kind of like consolidating over here. Now, I'm not saying that PayPal is a crap company. I'm not saying that. It is an okay company. It is making money, but PayPal is not a company I would buy. I've mentioned in the past because I don't think it's got a very strong economic moat. To me, investing in the business, the most important thing, it must have an impenetrable moat that protects the business from competition. And I think PayPal doesn't have a very strong moat. It has a lot of competition. So for stocks like PayPal, I will take short-term trades using options with a close stop loss and profit targets when I see the right trade setup. And I mentioned in my previous post on social media, and I think on YouTube as well, that there's a very strong resistance at the $68 level, right? It's consolidating over here, and only if you can break out of this very strong resistance, I may consider taking a short-term swing trade on PayPal, usually using options, right? But I wouldn't invest in PayPal because, again, long run, I think that it's not dominant enough. I like to only invest in dominant companies that have little or no competition in the long run. Another stock I think very popular with retail investors is Sophie, for example. That's down quite a bit. And again, Sophie is a company that I'll never buy as well because the banking business is a commodity business. It's very, very competitive, and I don't think they've got a very strong moat as well. So although these stocks have been down quite a bit, but I wouldn't buy them again. Another example is Unity Software. So this stock, I would say, is crap. Okay, I would say it's crap. For one simple reason, it doesn't make money. Okay, so again, cheap crap is still crap. I don't care how low it goes. I ain't touching this sucker. Maybe for a trade, but not for an investment. If you just take a look at, let's just punch in some of the, let's just look at some of the fundamentals. I'm going on to Guru Focus, and if you look at Unity Software, you can see, yep, it's not making money, right? It's been losing money all the way, okay? Free cash flow is negative, net profit negative. So when a company doesn't make money, what are you buying? You're buying a story. You're buying, a future that maybe one day it's going to make money. And sure, some of them will eventually make a lot of money, but most of them don't, And Unity is one of them where recently I think, well, in the first place, they never had a strong economic moat. And I think their business model is being significantly disrupted by the new AI software alternatives, being disrupted by OpenAI, disrupted by Meta's Lambda, is it Llama or Lambda, whatever it is, right? So, these are stocks, again, no matter how cheap, I wouldn't touch them, okay? So what are the stocks that I would buy? I would buy stocks that are great companies. They've got really strong economic moats, but their share prices are down for short-term reasons. But the long-term growth prospects and the long-term secular trends are still intact, okay? So how do you find the great companies from the crap, or the ones that are not as strong? So there are a few ways to do it. One of the ways is you can go to Trading View, right? And you can look at their stock heat map, for example. And you can look under the Dow Jones. These are all the 30 stocks in the Dow Jones, and notice the ones that are down year to date. So for example, Cisco is down 6%. I wouldn't touch Cisco because, again, Cisco, I wouldn't say it's a crap company, but to me it's not a great business. And yeah, I wouldn't touch Cisco. Intel, again, I wouldn't touch Intel, no matter how cheap it looks. Boeing, I wouldn't touch Boeing at all. Long-term structural issues, execution risk. Salesforce, that's something that, by the way, I already own Salesforce, so maybe a bit of biasness there. But Salesforce, they've got a huge lead in market share versus all the other companies in customer relationship management. It's a great business, and it's just down for short-term cyclical reasons. Same thing with United Health. I think it's a great business, down for short-term reasons as well. So these are the companies that I would look at to add or to build a position. Companies like McDonald's, all-time long-term great businesses, even Nike, for example. If you take a look at the NASDAQ 100, these are the 100 companies on the NASDAQ. Again, the NASDAQ is up double digits this year, but not all stocks. Within the NASDAQ, you've got stocks like Lululemon, that's down 38%. Okay, and I just added Lululemon, in fact. I think Lululemon's a great business. It's got a big runway, but again, it's down for short-term reasons, in my opinion, okay? Adobe as well. Adobe's down for the year, 9.5%. Cisco is down. Mentioned Cisco. Cisco's in the Dow Jones as well. Intel's also in the Dow Jones. And of course, you've got Tesla, which I won't mention more on that. You guys know my take on Tesla, right? Starbucks is something I wouldn't touch as well. Starbucks down 16%. Pepsi is down. Slightly down 1%. And I did add some Pepsi, by the way. You can also look at the S&P 500, which is not loading for some reason. Oh, no, it's loading, okay? So within the S&P, you can see the same suspects, right? McDonald's, United Health, Tesla, Johnson & Johnson, Salesforce, Adobe, Accenture. And so these are the stocks that you could look at. And again, how do you know it's a high quality business? You need to have an investment checklist, an investment criteria before you add it in. And we all have our own investment criteria. I've got my own, which I've shared before, and I'll share with you again a few things I look at, right? But before that, you can, by the way, also look for stocks that are not within the Dow, the S&P, or the NASDAQ. You can look for stocks outside the indexes, no worries, right? And one way to search is using some screeners. There's some free screeners like Finviz, for example. And if I go to Finviz, let's go to finviz.com, okay? Go to screener. And I'm looking for stocks that are down this year, all right? So I could go to technicals, and go to performance, and I'm looking at this year. Yep, year to date, down for the year, right? Year to date, down. but I only want companies that are at least mid to large cap, right? Or you may even want to only select large cap. It's up to you, right? So you can say large cap and bigger, large and mega cap stocks, or mid, large and mega cap. It's up to you. Do you want only very big companies, or are you okay with medium-sized companies? But let's just select large cap and bigger. So we only focus on the biggest companies, the strongest companies that are down year to date. And of course, we want to make sure that these companies are making money. They are consistently profitable. We don't want to buy loss-making companies that are, only built on speculation and stories. We want actual solid earnings, okay? So I want to make sure, for example, the last 5 years, their earnings growth has been positive. They've been growing their earnings for the last 5 years. That means the company is consistent. It is predictable, all right? I want companies where their sales has been positively growing in the last 5 years. I want companies, sorry, this is the next 5 years, my bad, all right? So last 5 years is over here. This should be positive, okay? And in the next 5 years, I want the growth to be at least 5%. If you're looking for companies like Pepsi or McDonald's, then it's about 5-10%. If you're looking for more higher growth companies like Salesforce or your, what's the other one? Lululemon, right? Then it's over 10%, for example. So it's up to you to set how high a growth you want. What kind of companies are you looking for, right? But let's just put over 5% for now. We can always adjust that. We want companies with a return on equity of at least 12%, but there's no 12% here, so I'm just going to put over 10%. And earnings growth next year at least 5% as well, okay? So this is not cast in stone. You can put in your own criteria, but these are some general criteria to make sure that we are investing, we're looking at businesses that are consistently making money, right? Return on investment, at least 10% as well, all right? So how many stocks come out from the screener, right? Out of over 6,000 stocks, it has screened 59 stocks. So there you are. So you can use that as a short list to then analyze out of the 59, which are the strongest ones you can consider adding to your portfolio. We can look at their chart patterns over here to give you a quick glance. You've got Abbott Laboratories that appears in the screener. Abbott's a pretty good business, right? You can look at Abbott. Accenture, great business as well, down for the year. And Adobe, great business as well. Align, great company as well. We've got BlackRock, which is, a pretty good business. So quite a number of great businesses are down for the year, even though the markets are all-time high. So these are the undervalued gems, if you will, okay? Let's see what else pops up. IDEX, right? IDEX is a great business, but IDEX is still overvalued. I wish it would get cheaper, but it's a great business. Lululemon, there we are. Lululemon appears. Monster's another great company. One of their new competitors that's coming up is Celsius, which is pretty interesting as well. Pretty interesting business. I just took a small stake in Celsius recently. We've got Nike. We've got PayPal, which I mentioned that can trade it short term for me, but long run I don't think they've got a very strong moat. So quite a number of names. Ulta Beauty, that's another great business. United Health, another great business. Viva Systems, another great business. So you can see quite a number. Yum China. So again, Yum China. Okay, China exposure in China. Okay, forget it. Right? I told you I'm done with Chinese stocks. Done with it, okay? Zoetis, another great business. Zoetis is a pharmaceutical company that dominates the animal health industry. So that's how you can find ideas. Now, so how do you know which are the best ones? Again, look at the fundamentals and look at the charts. And example, Lululemon, if you want to do some research into it, take a look. Is it a great business? What do I look at? I look at things like, is it consistently growing its revenue? Yes. Is it consistently growing its net income? Yes. Is it consistently growing its free cash flow? in blue. Yes, right? So this business looks consistent, it looks predictable, and it's generating high returns on equity. 41% ROE, that's fantastic. Any business with an ROE more than 12% is an excellent business, consistently above 12 to 15%, right? Return on invested capital, 37%, that's extremely high as well. So these are indications of a superior business with high ROEs, ROICs, high gross margins, high operating margins that are increasing over the years. These are the things we look at. You can also look at their balance sheet. Are they financially strong? All right, so you can see debt to EBITDA ratio is 0.5. That means they can pay back all their debt in just half a year of their earnings. So very conservative business. These are the things that we look at. And you can see that in the long run, Lululemon way outperforms the S&P 500. You can see that over there. But in the short term, you can see that it's corrected down over 30% because of some short-term slowdown in their North America sales. But Lululemon, unlike Nike, is still very US-centric. They are kind of like almost 80% of their sales is from North America and Canada. So there's still a lot of international expansion. What's really important, like I keep saying, is that when you invest in a business, you must be confident about the economic mode of the business. And one of the ways to be confident is that you use the products yourself. You are a customer yourself. And for myself, I'm very familiar with Lululemon because my wife goes to Lululemon. She buys at least a couple of articles of clothing from Lululemon at least twice a week. And she buys for herself, she buys for my daughter, she buys for myself. So in fact, if you look at my wife, 90% of what she wears is Lululemon. I must mention that my wife is also a Pilates teacher, right? Yeah, and my daughter's the same thing. My daughter's like probably 1/3 of the time they're wearing Lululemon, and my wife now almost everything she buys from me is from Lululemon, right? And that's why I understand the business. So it's very important to only buy stocks of businesses where you use the products yourself. Then you understand the business. You've got conviction in the business, and that's one reason why I don't buy Starbucks, because I don't drink Starbucks. I get my coffee at the local coffee shop, right? So that's the point, okay? So that's Lululemon, but again, it's not just about great company. Are you getting a good deal? So you have to learn how to calculate the intrinsic value. That's what we teach in our investing courses, using a discounted free cash flow model. And for Lululemon, you can see my intrinsic value is $357. So right now at 311, it is undervalued, right? It's undervalued, and it's kind of like consolidating within these two support levels. So that's an example of a stock that I have added recently. I'll share with you one more example, which is Pepsi. Now, a lot of people may not realize, but by the way, some people say to me, "But Adam, I see you drink Coke all the time. Why not buy Coke? Why you buy Pepsi?" Well, between the two companies, Pepsi way outperforms Coke in the market. It has a much higher growth rate. So let me punch in Pepsi over here. And let's compare Pepsi with Coke. There we are. So you can see that, Pepsi way outperforms Coke over the long run. And the reason is because Coke just sells Coke beverage, although they do have some other brands like 7-Up, right? But Pepsi, in case you don't know, their drink, Pepsi Cola, by the way, I don't like Pepsi Cola, the drink, right? But I love the other brands that they have, and I use many of the other brands. So what are the other brands of Pepsi? I'm not promoting Pepsi, by the way. I'm just sharing why I understand the brand, because I use a lot of their products. So Pepsi owns Cheetos. I love Cheetos. I love Captain Crunch. They own Doritos. I love Doritos as well. I love Fritos. Yeah, you can tell I'm a snack junkie. I love potato chips. They own Lay's potato chips. They own, what's the other one? Quaker Oats, which my children love, and so do my folks. And they also own the Starbucks brand. Well, it's a co-ownership. So when you go to supermarkets, you notice they sell Starbucks drinks. Yeah, so that is owned by PepsiCo, by the way. All right, so they don't do just the drink Pepsi, they've got a whole thing. Now, the thing to understand about Pepsi is that Pepsi, McDonald's, Procter & Gamble, Yum Brands, these are what we call consumer defensive stocks. So they're not high growth like Lululemon, like NVDA, like Microsoft. They are very low growth. They grow at less than 10% a year. So these are stocks that I don't hold for the long run, right? Because in the long run, these stocks, they don't outperform the S&P 500. So again, if you take a look at this chart, you can see in the long run, these low growth companies, they do not outperform the index. Let me say, then why buy them for? I might suggest buy the index, right? Absolutely, don't hold them for the long run. But I only buy these stocks when they are significantly undervalued. And because they're so cheap, I accumulate them. And then when they start to bounce back nearer their intrinsic value, I would sell covered call options. And by selling covered call options, I generate some additional returns. Usually I aim for these kind of stocks, about 1 to 2% return a month, which is pretty good. It's like, 12, 24% return a year on these low growth stocks. So low growth stocks, you can get double-digit returns if you buy them when you're very undervalued and you learn to sell covered call options on them. Then you can get double-digit returns on these stocks. But once they're overvalued, I don't hold them for very long. I would then sell them. Same thing with McDonald's. I actually bought McDonald's very cheap a couple of years ago, and I sold most of my McDonald's shares at the high. And now that McDonald's has dropped from the high, I've slowly been buying back. But I have not bought a lot back. I bought a bit back because I'm waiting for it to go even lower, hopefully, right? So in other words, you can make money in all kinds of stocks. You don't just have to make money in the high growth stocks. You can make money in the low growth stocks as well. But they all entail a different strategy. And of course, when your portfolio has a good combination of not just technology, but you've got technology, you've got consumer staples, you've got financials, you've got healthcare, you have a well-balanced, diversified portfolio that will do well under all kinds of economic conditions, provided you buy the highest quality businesses. So a quick look at Pepsi. Yeah, there we are. So you can see that Pepsi, if you look at the long-term chart on weekly candles, you can see it went down, it hit the 200-day moving average, bounced up, went down, bounced up, went down. And again, it's bouncing off this 200-day moving average. So technically, it is at a pretty strong support level, and the intrinsic value is 188. So at the current price of 167, it is undervalued, and it is kind of like bouncing off that 200-day moving average. Now again, these are stocks that you can invest in for the medium to long run, and you can also trade these stocks. Now I'm doing both, right? So in my main portfolio, I'm just buying Pepsi for an investment. But in my trading portfolio over here, you can see I recently traded Pepsi. This was a short-term swing trade where I entered Pepsi on the 14th of June. I bought it at 163. And I sold it, I took profit on the 21st of June at 169. So roughly about $5 I got out, right? I got out of the trade. And it was just a very simple swing trade, which I took over here. You can see this was a low, and we call this a double bottom, you can see? So once it made a double bottom, right, I bought there and I took profit right here. And I put my stop loss there. So I had a good risk to reward ratio of 1:2. So this was my entry point, that was my stop loss, that was my profit target. So I was risking 1R, which is the percentage risk, to make 2R. Okay. So again, in my trading, my trading account, I traded Pepsi, got in, got out very fast. But in my main investment account, I didn't sell. I'm accumulating a bigger position and then selling covered calls once it gets probably higher, probably at 177, 181, I'll start selling covered calls on this, right? So these are just some thoughts that you can think about how to take advantage of some still attractive, high quality companies in this market. Hope this has been useful. Keep watching, subscribe if you have not done so, and I'll see you in the next video. And as always, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.